All right, good morning, everybody. Just letting some folks join here for just a minute. All right, welcome to the Hurley Investments Trade Findings and Adjustments of September 8th, 2022. I am Keith Bybee with you as, I was going to say always, but most of the time here on Thursday mornings. Just to give you a bit of a recap, we talked a couple weeks ago, August 25th, this day, kind of before everything started to fall, and this is really where we were starting to get protection on. Actually, it was probably one of these 2 days. But along those few days, getting protection on our shares of stock in the form of put options, and seeing that S&P 500 hit that 200-day to the penny and start to fall back down. We talked a little bit about news that was contributing to that, and that was back when Powell said they weren't considering slowing down their rate hikes and basically are going to continue to be aggressive on their rate hikes until inflation slows down. You heard Kevin talk numerous times, but especially last Monday, about how that line of thinking is kind of doesn't make sense, specifically because the line of thinking that the Fed is going to fix the inflation problem with rate hikes. That line of thinking is, in our opinion, mistaken, simply because a lot of the inflation issues have been because of supply chain issues and commodities. And it doesn't seem as though raising rates is going to fix that issue. And the fear that brings, and I think that the market is fearful of as well, is just the fact that the Fed's going to be too aggressive in raising their rates. They're too late to the plate, and they're going to send our economy into a recession by being too aggressive with rate hikes. So that's kind of the fear right now. Having a bit of a rally from today and yesterday. It was down, market was down earlier. Powell did give comments at Jackson Hole and basically said everything I just said. Talked a little bit about Baidu, but we can, if you're interested in hearing more about that, you can go back to the webinar on the 25th. Today, though, I am going to keep it simple, but essentially just wanted to reiterate what Kevin talked about on Monday, which is simply that our market has, for the last months and last 6 months of in total of this year, has had periods of falling down, trying to get back up, falling down to lower lows. You can kind of see once it started at the beginning of the year here, fell all the way down, broke the 200-day, and it's kind of never been quite the same since. We did have this really strong rally in March, that topped up close to the same lower highs here, but just about every single time you see a little bit of support trying to get the market trying to get back, heading back down to lower lows. Several weeks here, just trying to create a base and get higher before falling down to lower lows. Another one here, trying to get back up to that 50-day before falling quite crash-like dramatically. And of course, through the summer, we've had a nice long period of the market coming back and what looks like a bear market rally up to this 200-day, and like I said earlier, down to the penny basically. Hitting that, falling down pretty dramatically. Trying to rally here last month, falling down. So it looks like to us, this little bit of a rally back to the 50-day is just that. Kind of zooming in a bit closer here, you can see there's some support on that 3,900 level. If I can kind of draw a bit of a line here around there, about 3,900. You can see a couple times held it, fell through it, rallied back, and then it was resistance level here, resistance level, resistance, and it wasn't until this summer rally that it really stayed through it. So I can see why maybe there's some buying support on that support level, on that price level. But I honestly don't see where we can get above a 50-day right now. Getting close to it, maybe another day where it really truly tests it. I mean, it is certainly very close to it today. But our line of thinking has simply been, well, if it's gonna make a bit of a rally, bouncing off a support level, coming up and testing at 50-day, again, there's really nothing in the way of news or even the time frame. I mean, we're obviously in our bearish months here, September, getting close to, October, the worst month. So we're thinking more about protection. And even though we have protection on, something like a SPY S&P 500 ETF, our SPY bear puts, is something that we're considering just to give accounts and clients a little more protection on the way down, and running things that way. So if I can kind of summarize this in writing, market seems to be having a short bounce on support price level, but there is no real I guess you could say the jobs report was a real positive, but declining unemployment has also been good news that the market has taken poorly because the Fed will continue to raise rates. And we're also, summarize again, so the market looks to locks. Let's try that again. Test the 50-day moving average, where we will look to add something like a SPY bear put spread give us more protection on the way down. So why SPY bear put? The spread on the short side will make it a bit cheaper. That's really it. Sorry, I'm not being very interactive, but so far, do you guys have any thoughts or questions that I can answer before I move on a little bit here? Those of you just joined a little while ago, the only thing you missed was simply just reiterating some of the things that Kevin talked about on Monday. Market goes up, market has been going down and then tries to rally and then goes down to lower lows, and it's been doing that for most of the year outside of that this last summer rally, and looks to be continuing that as we head through our typically historically worst months of the year. So looking to have more protection on, and this was our idea. Talked about QQQ puts as well. Those are a little less expensive, and that might be another idea, but those have just, for no other reason, those ones just have not worked out for us. Made some money on some and lost some on others, and so kind of going through something like a SPY might be a little more easy to read. Not seeing any questions come in quite yet. What else are we looking at? Our banks. So we got a article yesterday posted on, I think it's in the CNBC Pro, so I'll read some parts from it for you guys since I can't really link it. But long story short, banks, we're looking at possibly taking protection off. And you're probably thinking, oh my gosh, I forgot how to spell possibly. There we go. I thought I did it like that. All right. So the idea is taking protection off. Keeve, why on earth would you do that? You just barely told me we're trying to be more protective. We're in the worst months here, etc., etc., etc. And it goes back to that article I mentioned, and check out this. This is Bank of America. See, it's ridden along this 50-day for quite a long time. Really never participated in the summer rally at all. Well, I guess it kind of did here, but for much of it, it went sideways. Tried to and struggled to get over that 50-day for the longest time, but a couple days here where it fell below the 50-day, closed below the 50-day on one day, and immediately bounced up. Nice bounce today. Let's look at JP Morgan. And obviously looks very similar, as these banks tend to do similar things because they make money in similar ways. So go over a couple of points from this article. And really, basically, it looks like somebody's finally seeing what Kevin and I have seen and thought of in our bank stocks. And it's simply that rising interest rates are going to help the banks. So he goes over a few numbers. Let me see, what's his name? Highlighting how banks should do well in rising interest rate environment if the economy avoids a recession. So some numbers he goes over: loan balances, and I'll put a little quote here since I'm really directly quoting this. Loan balances for the industry are heading for a 2.6% quarter over quarter increase with higher rates. Should support more net interest revenue growth. Oh my goodness. Trying to type and read is too complicated for some people, apparently. All right, so what is he saying? There's still a large amount of loans, and there's increasing loans still. Banks earn interest off of those loans, and when rates are increasing, that's going to increase their revenue naturally with having all of those loans on their books. He also says loan losses on credit cards, other products are still low. So less people defaulting and having issues with credit cards and things like that. Great for the banks. Still showing a strong consumer, in other words. Let's see, anything else? He says companies are going to be recording third quarter results next month and expected to post about 3% revenue growth and per share earnings jump of 7%. They are also seeing, let's see, 20% upside on banks in general. I'll say analysts because it's basically saying him and other people. 30% upside on specifically Bank of America, JP Morgan. They also mentioned Goldman Sachs. We care less about that, but you guys know Bank of America, JP Morgan are big parts of our portfolio. So they're essentially saying, and analysts are essentially saying that specifically the best banks could see more of a 30% upside in comparison with the 20% for the rest of the banking industry. So kind of nice once in a while to hear an analyst, as we like to affectionately call them, agree with some of the things we've been talking about for the last year and a half, 2 years here. Higher rates should help the banks. And simple as that. And really, employment rate and good jobs still available, and those parts of the economy of consumers and their buying power, as long as that stays intact, we should see good profit from these banks. And if nothing else, it looks to be that the market is following through with that and thinking the same thing as well, with the bounce after the article came out. So we'll see if that follows through, but definitely holding our 50-day today. It's looking good. Let me just update Bank of America again. Hitting that pivot point, but that's some things that we're thinking about as it looks like banks might start to take off and trend in a different way than the market looks to be taking in direction. So that's it for me. That's all I had for you this morning. Ladies and gentlemen, is there any other thoughts or questions I can go over? before we wrap it up this morning? Jim asked thoughts on stable coins. To be honest, Jim, I honestly don't follow them much, but as I've seen, you've probably noticed through this year, the stable coins, they're supposed to be pegged to a certain dollar amount and just supposed to be far less volatile, more reliable as an actual currency as opposed to some of the other Bitcoin and Ethereum and so on. But they had huge issues where most of them, probably all of them, had struggled and fell in value. And for that reason, simply because they can't really follow through with what you'd expect on a stable coin, I would not be looking to invest in any of them. So those are my thoughts for you. Any other questions? All right, there's nothing else, guys. Thanks for joining me this morning. Sorry for the late start. If you haven't seen or listened to Kevin's webinar from Monday, definitely one that you should check out. Thanks, Jim. No problem. All right, guys, take care. Have a good Thursday. Have a good weekend, and we'll see you next time.